Bismillahirrahmanirrahim. In the previous class, if you people remind, we discussed about users of financial statements. That these are basically the users of financial statements. We discussed that there are two main types of financial statements. One is balance sheet and the other is income statement. Then after that, we discussed about these external users of financial statements. Trade creditors, those from whom the company is purchasing goods on credit. Bondholders, those people who are purchasing bonds of the company. And shareholders are those people who are purchasing shares of the company. And we discussed about the bond and share in detail. Now, internal users of financial statements. So the main internal user of financial statement is basically the management. And management is using financial statements for planning, for controlling, and for understanding. Now the first thing is plan. Focus on assessing the current financial position and evaluating potential firm opportunities. Management is using the management is using financial statements to analyze the current financial position, the profitability, the current, and on the base of that, they're evaluating if there is any potential firm opportunity, if there is any opportunity available for the firm, so they are checking that. So management, they are using this financial statement for planning purpose. They are studying income statement, they are studying balance sheet, and if they are watching any opportunity, so they are telling the top management about that, and then top management is taking a decision on that. So in internal users management, they are using financial statements for planning. You know about budget. In budget, they are studying these financial statements, and on the base of that, they are making a budget. They are studying past financial statements, and on the base of past financial statements, they are making a budget for the future. So that you can also say that that is an example. The second thing, that they are using financial statements for control purposes. Focus on return on investment for various assets and assets efficiency. They are checking the performance of various assets, and on the base of that, they are taking decision. They are controlling. They are checking the return on investment of your cash, your short-term investments. Here you will not understand this point, because when you study this financial statement analysis in detail, then you will get this thing, that how will you control the assets, the various assets and assets efficiency. So later on we'll talk about this in detail. Understand means a focus on understanding how suppliers of funds analyze the firm. They are they are checking that if we will apply for a loan from banks or any financial institution, so how will they look at our company? How will they look at our company's financial statements? So they will try to make these financial statements attractive for these suppliers. So they are also using financial statements for understanding. So focus on understanding how suppliers of funds analyze the firm. When we study these things in detail, then I will come back at this slide and then we will discuss it again. Now, the first main financial statement, it is balance sheet. This is Basket Wonders, this is the company name, balance sheet, and this is asset side. Which side? Asset side. Cash and cash equivalents is equal to 90, but see here is thousands, in thousands, so it is 90,000. One is cash, you know about cash. What is cash equivalent? Cash equivalents are basically in chapter 7, we'll study it again. Cash equivalents are basically those investment which will mature within 3 months. Account receivable, you know about account receivable, 394,000. Then there is inventories, you know about inventory, the stock that you're going to sell, 696,000. Prepaid expenses mean the payment that you made in advance payments. Accumulated tax prepay, sometime the taxes are paid in advance. How? This is also a point, but I'm not going to discuss it here because you people will not understand. So these are our current assets, this plus this plus this plus this plus this, so 1195. Then these are our total current assets. Fixed assets at cost. So fixed assets, their total cost is 1030, means there will be 1000, 3 more zeros, and less accumulated depreciation. And you know, from the cost of asset we are deducting depreciation. We studied this in financial accounting, that from cost we are deducting the depreciation. So our net fixed assets are 701,000. Then there are some other assets, investment, long-term investments, investments in bonds, investments in shares, so it is 50,000. Other assets long-term, there are some other assets, long-term assets means intangible assets, you can say goodwill, patents, copyrights, these things, so their value is 223,000. So these are current assets, these are fixed assets, and these are other assets. So total will become, these are current assets, these are fixed assets, and these are long-term investments, and these are other long-term investment, long-term assets. So our total assets had become 2169. Here is basically the explanation for these items. Cash and cash equivalent, how the firm stands on a specific date. Basically this point A, now see here, just a minute, C A, this is A, how the firm stands on a specific date. Basket Wonders balance sheet on December 31, 2003. on this date, December 31, 2003, how the firm stands on this specific date. Now see B, where is B? B is this total assets, what Basket Wonder owned. C, so C here will be a point C. This account receivable. So amounts owed by customers means that amount that customers will pay. D, future expense items already paid. D, this one, prepaid expenses. So these are basically explanation for these items. Now, the liability side of the balance sheet. Basket Wander's balance sheet, liability side. The first item in the liability is notes payable. It is 290,000. Then there is accounts payable 94,000. Accrued taxes means the taxes which are not paid 16,000. Other accrued liabilities, other liabilities which are not paid, suppose rent is not paid, suppose salaries are not paid, suppose some other liabilities are not paid. So now we will add all these. So we got $500,000. This is in thousand. So these are current liabilities. Then there is long-term debt. So long-term debt, suppose we took a loan from a bank. So it is 530. Notes payable and accounts. There is a difference between these two. Notes payable is that loan, short-term loan, for which there is a written evidence. Suppose I took loan, suppose I purchased goods from someone on credit and I told him that I will pay you this money after 3 months, and I give a written note to that person. One is account payable. This is basically word of mouth loan, short term. And I purchase goods from someone and I am telling him that I will pay you this money after 1 month. There is no written evidence. So accrued taxes, taxes which are not paid, that you will pay in the near future. Other accrued liabilities, salaries are not paid, uh, electricity bill is not paid, telephone bill is not paid, etc. And these are our long-term debts. Then there is shareholders' equity. Now this is important. Previously, in the previous classes, when you were talking, so we were talking about owner's equity. Owner's equity. But here is shareholders' equity. This is basically balance sheet of a company, joint stock company. So this thing is new for you people. Shareholders equity. Now look at this. This is a company. They are in need of money, so they issue shares. Keep in mind, each share it has a face value. So here in our example, the face value of share it is $1. Look at this. Common stock $1 par value. So mean the company issued 200,000 shares. This is basically the face value below which you can't sell any share. So the company sold these shares. So we call it common stock. So we received 200,000. We will receive at least $200,000 from the sale of these shares. So we call it common stock. But here is another item. Additional paid in capital. Look at this. Additional paid in capital 729. 729,000. What does it mean? It means that okay, the face value is $1, but we receive 8 sorry 9.29 additional money. Means this is the face value below which you can't sell your shares. But the company's performance is good, so they sold the shares for 9.29, means they receive additional money. Take another example. Suppose face value is 100, below which you can't sell your share. But the company received $500 for this share. So this $100 we call it common stock at par value, at face value. But we received $400 additional. So that additional 400 that you received, we call it additional paid in capital. So here you received 200 for the face value and you received 729 additional paid in capital. Means you received 729 additional for the sale of each share. Then the next item, that is retained earnings. What is retained earnings? When the company is doing business, they issued shares, they received money, cash. On that cash, they are doing business. And on that business, they generate profit. Out of this profit, they are giving a portion to this public, these people, these shareholders. A portion. Suppose on this business, company generate 100,000 profit. Out of this $100,000, they distribute $30,000 in the shareholders. This is called dividend. The remaining 70,000 that the company retained it in the business. They didn't distribute it. Why? They will use this $70,000 in the business. This is called retained earnings. Here retained earnings. So retained earnings are basically that portion of profit which is reinvested in the business, say 210,000. So then they add this current liabilities, long-term liabilities, and total equity 1, 2, and 3. So they receive 2,169. So check the assets 2,169 and check the liabilities. It is also, sorry, the total equities. So it is also 2,169. Inshallah, in the next class, then we will talk about the other, sorry, the income statement and different other things. Okay, have a good time.